I'm Stewart Fleming. I'm a senior member at St Antony's College. I'm a journalist by background, not an academic, so that's me done with. This is the final seminar for this term in the Political Economy of Financial Markets programme. And we're going to look at the role of the IMF in the Western Balkans. The IMF has a long history in that part of the world, in Yugoslavia initially. And correct me if I'm wrong, but in 1979, it was the IMF's annual meeting in Belgrade, which Paul Volcker left in a great hurry in order to defend the dollar and fight inflation rates.
Good word of it, yes.
Yeah, I'm sure it was. Pretty sure it was. However, but then after the fall of the Soviet Union, the IMF continued to be very deeply involved in the region in its successor states with both program assistance, technical assistance, and with official IMF programs in some of the countries. And I imagine that would be with the World Bank and the EBRD as well. I'm not sure how involved the European Union would have been involved, but you might want that issue as a coordination issue, or something you might want to talk about, I don't know. Looking at the background to this situation now, the West Balkans experienced a credit boom like the rest of the transatlantic region between 2002 to 2007. But in this particular region of the world, the boom was milder than in the rest of Central Europe, and certainly less than in the transatlantic region. But the recovery was milder as well. At least that is the IMF's take on this from the recent report on the region. So if you want to argue with it, that's good too. The recovery has been moderate in the last couple of years. It's supposed to be getting a little bit stronger next year in 2016, but still only about 2% across this part of the region, I think, at least from the IMF's figures. To talk about this background and the region, we have Robin McConnachie, who spent 20 years as a senior British civil servant, initially at the UK Treasury, and then after 1985, I think, Robin, at the Bank of England. Yep. He has particular expertise in this region because he worked at the Centre for Central Banking Studies, which the Bank of England set up to provide technical assistance in the post-communist states, and that was set up in 1985. No. You don't? No, it couldn't be. Around 1990s.
Planned in 1990.
Yeah.
Set up in a sort of small way in 1991, and then full strength on in 1992, and it rapidly expanded to the world.
And Robin, you were actively involved in this region with that institute. Adam Bennett is also well known to us. He is an academic visitor at St Antony's, Deputy Director of PEFM, and an Associate of CSOX. He also started his career at the UK Treasury before moving on to the IMF, where he had a very distinguished career. And looking at the long list of countries he worked in, Afghanistan, Pakistan, the West Bank and Gaza and Italy, it was a very interesting career as well, I think, Adam. Who's going to start?
Well, I'll start. All right. And what I'm going to do is I've dusted off a presentation I made about a year and a half ago for CSOX and the Bank of Albania, looking at the IMF record in the Balkans, but in a quantitative way. Now that seminar was invitation only and attended only by officials from the region. So I thought that it would be worth opening us up to a wider audience for people to see my results more widely. And maybe just make the page come down. Here we are. Now there are various different ways of measuring the effects of IMF programs. One is called the before-after approach. Now this is the easiest way, in a way, to measure the effects of IMF programs, because you simply compare the outturn of key economic variables during an IMF program compared to the period immediately preceding the implementation of the program. But the problem with this approach is that in order to assess the contribution of the programme, one really needs to know the counterfactual. What would have happened in the absence of a programme? Moreover, the before-after approach fails to distinguish the contribution of the programme from the contribution of other relevant but exogenous variables. So it's an easy approach, but it has certain problems. Then there's what's known as the with-without approach. This compares the experiences of the countries with programmes to those without programmes. And this obviously corrects automatically for exogenous shocks of a common nature, such as changes in world trade or commodity prices for groups of countries that are in similar situations. But the with-without approach is also not free of its own flaws. Notably, countries with and without programmes are rarely in entirely similar situations, most particularly because countries with programmes have typically been selected because their starting positions are worse than those without programmes. So another approach is called the generalised evaluation estimation approach. This attempts to correct for differences in initial conditions as well as for differences in policy reactions with and without a fund programme. But this requires the modelling of reduced form relationships and that be estimated between policies and starting conditions and between policy reaction functions for countries with and without programmes. In principle, this is a sort of an ideal approach, but it is only as good as the estimated equations and the data that goes into them. So it's in principle a good idea, but it falls on the quality of the data and the models which are used. Then there's the comparison and simulation approach. This is the most ambitious approach. It involves constructing an entire model of a typical developing country and to explore the consequences of IMF programs, and then applying program adjustments to see what happens. I think it's a more value in assessing IMF program design in general, however, rather than in assessing the actual experience of countries, because it is essentially it's a model that it is of a general nature. Finally, there is the actual versus target approach. This measures program performance compared to program targets. This is a relatively straightforward analysis, but is focused more on program compliance and the consistency between planned policies and objectives rather than on the underlying effects. Now, the typical findings of analyses of the effects of IMF programs in the past have nevertheless, need to say, varied considerably, mostly in the degree of significance of the estimated effects of programs, and sometimes also even in the sign. But if any conclusions can be drawn from these various studies, it is probably the following: that countries with programs tend on average to achieve improvements in fiscal and balanced payments positions. They tend to have neutral or disappointing results as regards growth during the program, but score positive results thereafter. And they tend to have neutral results on inflation. Such findings are perhaps to be expected. The fund's primary objective is to restore a country's balanced payments position to external equilibrium. This takes precedence over internal equilibrium, such as inflation targets. So, what programs were approved in the last 10 years or so in the Balkans? I've listed them all up here, and you can see that virtually all countries, except Montenegro and Slovenia, have at one time or another had a program approved in this period. Some before the crisis and some after. This schedule here shows you the periods for countries when IMF programs were actually in place and functioning. And you can see that for some countries, at a lot of the periods were under IMF programs, majority. Others had, for example, Bulgaria and Croatia didn't have programs during this period after the crisis, only before. And countries like Bosnia have had a lot of programs, Albania have had quite a lot of programs, Romania have quite a lot of programs. So clearly, the IMF has had a presence in the region. So let's look at what actually happened in the region. We all know about the effects of the global financial crisis which was then followed by the Eurozone crisis. And this had a very abrupt effect on economic growth in the Balkans in 2009, following the onset of the crisis at the end of 2008. And you can see that before the crisis, growth was averaging in the region of 5.5% for all countries. Slightly faster for countries that actually had programs, slightly slower for countries that didn't. But for all countries, it ground almost to zero after the crisis. Now, it seems that this shift in growth trajectories was pretty much independent of whether a country had a program or not. Whether you had a program, you went down to zero, and if you had no program, you had 0.2 growth, which is a negligible difference. So, not a big effect of IMF programs on growth here. Inflation during this pre and post crisis period was actually fairly steady at about 4.5%, and it didn't really change much even after the crisis. And again, there's no obvious influence of IMF programs on the inflation path for those countries that had programs compared to those countries that didn't. When the recession hit, the fiscal accounts were also badly hit. You can see that before the crisis, fiscal balances looked quite modest deficits of the region of the order of 1 to 1.5% of GDP. This, in fact, was a chimera because the underlying fiscal position was actually much worse because the very rapid growth rates were flattering the fiscal accounts. And unfortunately, countries did not realize that these strong revenues were actually an ephemeral thing, and instead ramped up their spending. After the crisis hit, fiscal balances went into severe deficit of the order of 4.2% actually, right across the board. So there was a significant worsening in fiscal balances in between these two periods. Now, I should also point out that the IMF is in principle supposed to finance balance payments deficits, not fiscal deficits. Now, although the fiscal position worsened, the private sector in these countries cut back substantially. And the effect on the current account, which was in significant deficit in the pre-crisis period, was quite pronounced. So although the fiscal accounts became more in deficit, the private sector more than compensated for this. And as a result, the current account of the balance of payments approximately halved in the period after the crisis compared to the period before the crisis. But again, the current account position for countries that did have programs compared to the countries that didn't have programs, not very different. So you might well ask, what is the point of an IMF program? This seems to have no effect on anything. Well, the answer is in this slide. What I've done in this slide is I've created a concept of the balance of payments, which takes the current account and then added to it foreign direct investment, which is a pretty stable form of financing for the current account of the balance of payments because it's a commitment by the foreign investor. It's hard to withdraw. It involves transfers of technology. It's very stable. It can reduce to zero, but it can't very easily turn negative. So it's a relatively stable form of financing. So the question is, what is left to finance, and what happens to that? What one might call the true balance of payments that has to be financed by relatively short-term financial flows, which are much more fickle, such as purchases of equities and bonds and bank lending and cash and stuff like that. So what I've done in this slide is I have adjusted the current account with it for foreign direct investment to see what at the end of the day is being asked to finance in an environment after the crisis when there simply is no private capital flowing in. It's zero. So this here is the countries with programs, shows you that the balance of payments, even after you add in foreign direct investment actually gets worse. They're still in deficit. Whereas countries without programs, they go to pretty much balance. So what does this mean? It means that this is what the IMF is financing. The IMF is there to finance these deficits. Because if it didn't do that, and those countries were forced to contract, because they would have to be, because there's no foreign financing in that environment, they'd have to contract even more severely the fiscal accounts, or force the private sector to contract even more. And that would mean that growth would have been much more negative during that period. So what this it really represents is a classic case of the IMF doing what it was asked to do in the Article 1, when it was set up in Bretton Woods, which was to provide financing to enable countries to pursue adjustment programs in such a manner that was not unduly damaging to their growth and prosperity. So the IMF is there to help them finance those kind of deficits, while they're at the same time pursuing adjustment programs eventually to get their economies back into some form of equilibrium. So now look at the another approach, the before-after approach. These are deputies of IMF programs in the Balkans. I'm not including Greece in this because Greece is it's a sui generis case as far as the Balkans is concerned. These are much more standard IMF programs. And unlike Greece, they did not involve the Troika. They were IMF only. So they were, in a sense, a much more classic kind of formula. And for growth, for example, the IMF recognized that growth was likely to be pretty much zero during the course of the program, but that it should begin to recover after the program. In fact, the growth outturns were rather worse than they had hoped. And although there was a sort of recovery after the end of the program, it wasn't quite as strong as the program designers had hoped. For inflation, they expected inflation to fall a little bit. It wasn't really a big issue, so it wasn't that important. It did fall a bit, not quite as much. And by the end of the program, the target and objective were pretty much in line. Now, the current account, the targeted improvement was about 0.5% of GDP, and the actual improvement was 0.4. So the current account outturn was pretty much in line with what they had been aiming for. And this, in a sense, is important because that was what they were aiming to bring into equilibrium. Because they are, in the end, there to ensure that they can function in the global balance of payments. Fiscal accounts, they targeted an improvement at 0.4 per annum, 0.4% GDP per annum. But the actual outturn was actually negative. So a very distinctive failure to bring about the desired improvement in the fiscal accounts in these programs. If you look deeper into the reasons why the fiscal accounts didn't improve, it's mainly because of the failure to control spending. Here you have a plan to try and cut spending by 0.7% of GDP per annum, and in fact, it went up. And again, the year after the program, it was still higher instead of lower. On the revenue side, the outturns and out targets were quite close. So really, it was a failure to control spending. So, how do the IMF programs actually target fiscal adjustments? Well, it looks like the targeted adjustment in the fiscal accounts is basically proportional to the initial imbalance. So if you had a very large initial imbalance, then the targeted adjustment would be proportional to that. It wouldn't necessarily aim to eliminate it, but it would be. There's, you can see from this chart. There's a relationship between the targets, targeted change, and the actual initial position. So what I did is I estimated a little equation here. And I took the average change in the fiscal balance targeted during the life of the program. Some programs are 1 year, some are 2 years, some are 3 years. And then linked it to the initial fiscal balance and the length of the program minus 1 year. And it had a very strong relationship. These two variables are highly significant. So I think this gives you an idea that the size of a fiscal adjustment is, for obvious reasons, linked to the size of the initial imbalance. But it also reflects the length of the program. If it's deemed difficult to achieve the required adjustment in 1 year, then the program will typically be lengthened to 2 or 3 years to enable a more feasible adjustment path to take place. And interestingly, I took this result, which was estimated over 2004 to 2011, and then compared it with the targets in the Albania program, which was approved in 2014, and plugged in the Albanian initial fiscal position and 3-year programs into there, and then compared the targeted annual fiscal change in the fiscal position, which was 0.9, whereas my equation predicted 0.99. So I think it was close enough. Now, I'm not saying that IMF staff use a formula like this. They don't. But what I'm trying to do is try to model their behaviour to suggest that there is a relationship between the size of the fiscal adjustment required and the size of the initial imbalance, which makes eminent sense. So, what about Balkan conditionality during this period? We see here a table that shows all these programs here approved when they were approved, and then all these things here. Now, what do these mean? PA is a prior action. These are things which that countries have to do as a prior condition to getting the program approved. And you can see that a lot of countries had at least one prior action, and quite a lot had more than that. But over the years, the number of prior actions didn't change that much, except they began to pick up towards the end. Then QPC are quarterly performance criteria, and these are very powerful quantitative targets on things like the reserve position, domestic monetary creation, fiscal positions, and so on. And they're measured each quarter, and if they are not met, then the funding from the IMF dries up until they can agree corrective measures to restore the position. These are very important, powerful quantitative tools of conditionality. Then there are things sort of quantitative indicative targets, which are sort of softer and guidance based rather than a real hard tool of conditionality. Again, see that these were quite common, but not relied on as much as these the actual hard targets here. This SPC is the structural performance criterion. Now, this is when a performance criterion is applied on a structural measure, such as reforming the tax system or introducing new rules in the financial markets or whatever. And during the Asian financial crisis, and the IMF was at that time very persuaded that structural reform was as important as quantitative adjustment. The IMF got criticised for being far too intrusive in what it was doing, and it took this to heart, possibly I think a little overreacted, and began to ease off structural conditionality, even though if you look at the results of the IMF programs in the Asian crisis in the years afterwards, they seem to have done actually rather well. After all, they managed to avoid any fallout from the latest crisis. So they must have done something right. And it wasn't just quantitative targets, it was structural measures that they introduced. Nevertheless, the IMF felt embarrassed by this. And although structural performance criteria were employed in some of these early programs, particularly Romania, here we have 10, in 2009, they were abolished. They were made, and we were not allowed to have structural performance criteria because they were deemed to be too intrusive. We also had things called structural benchmarks. These were, again, rather like these things, softer, and they couldn't actually directly interrupt a program, but they were sort of guideposts. But as you can see, these structural benchmarks, which were quite common as well before the crisis and before the outlawing of structural performance criteria, became much more common afterwards, because it was the only way the IMF could give guidance on structural measures. But still, after the crisis, we felt that immediately when these things were abolished, the IMF felt it had to lay off intrusiveness and just focus on its traditional mandate of macro adjustment. And so the number of benchmarks were really quite low. And then by 2012, the IMF realised that actually we can't ignore structural issues. And these benchmarks started to proliferate again. And here you can see they went up to 10 in the case of Bosnia, 15 for Romania, and 13 for Albania. So these benchmarks started to have teeth, not because in their own right, but because every programme has periodic reviews. And an IMF review is an incredibly powerful form of conditionality, because it gives the IMF its ability to stop a programme by exercising its judgment about the sort of whole of the programme. And in that judgment, they can take into account all of these other indicators like structural benchmarks and quantitative indicators, which don't have formal conditionality in their own right. So with the reviews and with these structural benchmarks, structural conditionality came back. What about the money which was made available during these programs? Before the crisis, the amount of access, which access is an IMF word for money, or supply of money, and it's measured in terms of a country's quota. Each country of the IMF has a quota, roughly scaled to its size of its economy. And the rules are typically that you can have, say, up to, in any 1 year, a maximum of 100% of quota in IMF funding, and then there is often a cumulative limit. Sometimes it was 300% over a period of time. And most countries tended to have quite low levels, 25 or maybe 40% per annum. And these early figures here were of these orders of magnitude. Sometimes some of these programs before the crisis were cautionary, meaning that they were there really as a framework, and it wasn't because the countries needed the money, but it provided a sort of macroeconomic framework to enable them to continue to move through the process of transition. And for precautionary programs, because it was assumed the country probably wouldn't need to borrow, then the amount of access was really quite low. Then, of course, the crisis hits, and the IMF decides, it's going to be, they're going to forget about access limits. They're going to just open up the spigots and supply whatever they think is necessary. Forget about limits. There were limits, but they were quite different, and you could always exceed them if you under what's known as the exceptional circumstances clause. Now that was very rarely exercised until Mexico in 1995, and then later on in the early 2000s it became more regular. But now IMF access or supply of resources is a lot more flexible than it used to be. But you can see here that after the crisis, these amounts available of the financing rocketed. So in the case of Romania, it was 1,000% of quota, compared with earlier amount, only 24% of quota. So this is ramping up the amount of financing hugely. And of course, unlike these earlier programs, they were not precautionary. They needed the money. They drew on those resources, subject to their complying with their programs. So here you have all these big numbers. As the crisis eased off, these numbers began to get slightly smaller and slightly smaller. In the case of Albania, this number is slightly exaggerated because it's actually over a 3-year period. But still, there was a huge spike and then a gradual decline. But we are still well above what we were in this period. So the IMF is proving to be a lot more generous than it was in the past. So that's basically it as far as this quantitative analysis of the IMF and the Balkans. And it's a rather dry analysis, but it's just to show that that a lot of the criticism of the IMF that it crushes growth is actually sort of a bit wide of the mark. It actually has very little effect on growth compared to countries that don't have programs in similar situations. What it does do is prevent countries that have programs from going into even worse recession than they would otherwise do, because it provides the financing. There'll be other questions I'm sure you want to ask me about the IMF and the Balkans, but I suggest that what I do is I hand over to Robin to talk about the aftermath of IMF programs, which is the implementation of TA, often which is linked to some of these structural measures that are being asked of.
Robin.
Well, that was, I mean, I have had the privilege
Do you want to use it, sit here and put your thing up?
No, I think we'll put it up at the end, I think.
Okay.
Because I'll say what I'm going to talk about, then hopefully talk about it. And then, you know, when I was a university teacher, briefly, I was always told to set out your program, what you're going to say, do it, and then at the end, basically provide a revision of what you've said, right, which I'll try and do. Before I get stuck in, as it were, I thought I should say which are the countries in the Balkans that I worked during this period from 1992 to 1997 at the Bank of England. And then from 2000, when I ran my own business, roughly in this area, so the business expanded and the topics I was asked to cover rapidly expanded. Because I started off as an expert in government finance, particularly from the central bank point of view, government debt, borrowing deficits, all the things we've heard in previous seminars, but also getting down to the detail of how do you set up, possibly from almost scratch in some of the countries we're talking about, a securities market, or after 40 years of communism, revive the securities market and improve it, often in the context of an IMF program, either as a result of a condition, which the IMF, I was going to say impose, or I'd better not, and also what countries may, as a sort of consequence of a program, ask for technical assistance from the IMF, or indeed from other people. But which countries did I work? I have visited all the countries of the region, some of them many times. I've never actually got to Montenegro, but that's another matter. So quite early on in the period, 1992, I was advising the Ministry of Finance and of course also the Central Bank in Romania. That was in the area of monetary policy. I also did quite a lot on regulation of the securities market in Bulgaria at about that time. Within the former Yugoslavia, I did work there briefly when it was one country, but then I did two sort of mini programs with the Croatian authorities. I was several times in Macedonia. I was part of a reconstruction program in Bosnia-Herzegovina just after Dayton. And I can answer questions about that, which was a very interesting experience, where I had to pose as an expert on the Scottish banknote system. Now, I don't know how often the Bible is quoted at St. Antony's seminars, not often in my experience of Peckham, but stuck in a hotel room with a difficult situation late at night, I was often minded of the parable of the sower. And just to illuminate or to lighten the talk, just see as we go how many of the items in the parable are quite relevant to technical assistance. So, from St. Mark, behold, there went out a sower to sow. And it came to pass as he sowed, some fell by the wayside, and the birds of the air came and devoured it up. Had that. And some fell on stony ground, where it had not much earth. And immediately it sprang up, because it had no depth of earth. But when the sun was up, it was scorched. And because it had no root, it withered away. And some fell among thorns, and the thorns grew up and choked it, and it yielded no fruit. And other fell on good ground, and did yield fruit that sprang up, and increased, and brought forth some 30, and some 60, and some 100-fold. And he said unto them, he that hath ears to hear, let him hear. Well, I don't know about 60 and 100, but Adam has pointed earlier to the success of many programs. But it's not easy, and it's not easy for the countries concerned. So my first point is that ideally improvement in markets and country performance is locally originated and not externally imposed. Because people have a natural instinct, well, I know I have it, and I'm sure I'm not alone, is if you're told to do something, either formally, basically as part of a conditional program, or informally, you're perhaps a bit disinclined to do it. And you would much prefer something which is locally derived. And the trick is to try and match the giving of the assistance with developing local enthusiasm for it. Some of us are old enough to remember the IMF program in, was it 1976? Where the UK had to go to the IMF for a loan. And now the lender is entitled to impose conditions, but I was then a young official in the Treasury, not directly involved, but partially involved. And I have to say, and I'm sorry I'm being a bit critical, Adam, that the relish with which the IMF imposed on program on a country like Britain was not, I'll come back to this in other contexts, it's not on the whole a good idea. And you diminish the like by your behaviour, and I'm thinking in particular of Greece, irritating though the Greeks, perhaps even impossible, dealing with the Troika. Troika could have behaved more sensitively. I come back to that. But best example was I became an advisor early on in the period to the National Bank of Hungary. Came about almost by chance, one of these international conferences, and the great enthusiasm, and there was particularly enthusiastic reception in Hungary, which had a lively capital market transition, which had not been forgotten. And being there, 40 years of communism was swiftly disposed of. So they already had an advisor from the Bundesbank, and I had met the head of capital markets at the National Bank of Hungary, who was complaining to me, partly because I'd given a presentation which I think they had quite liked. But this advisor from the Bundesbank, Robin, he just tells us what to do, and the Bundesbank does this, and we should follow it. That's not really appropriate. I mean, firstly, it's arrogant. Secondly, you're unlikely to get people to work with you. But most important of all, and this is my second point, the advice has to be tailored to the conditions in the local market. I mean, the 6 countries as they were initially after the collapse of the wall are not all the same. In particular, the problems in each country are different. The financial situation is very different. The state of development is also different. And good advice, in my view, has to be tailored to and local market conditions, and it often is. In these early days, there was a huge problem because there was big demand for technical assistance. There was a sort of carve-out between Western countries as to what they could do to help the IMF programs, which, I mean, I have detailed criticism of them, but in general, you know, they're comprehensive. But the scale of the task was such that it inevitably became a sort of 10 days on a technical assistance mission, a little time to adjust and get your recommendations cleared with what we used to call the thought police in Washington. And I never forget my first mission, which was actually to Poland, and I was given helpful advice, and this was, here's the report we've just done on Czechoslovakia, just delete Czechoslovakia and substitute Poland. Now that's an exaggeration. Part of the problem was that there was simply excess demand, and then the IMF missions were often had to be staffed by quite junior people who were making quite important recommendations. So they put a few sort of older central bankers in it to, well, spread the workload, really. But of course, this takes time. So ideally, you want a sort of blueprint, and then what can work well is to have the IMF all-covering wings, but it's impossibly difficult in terms of the resources, have local or locally sympathetic advisors to carry these general recommendations, which are sound and correctly intellectually conceived and may or may not be part of a program with conditionality, and then work them into a state where they will work because they're appropriate to local conditions. And I've got one or two examples. Still on my theme, but I make it a separate point. You don't want an advisor, or even an individual advisor working for or paid for by the individual country, to write an alternative report, a second opinion, if you like, going into more detail than, say, the IMF or some occasions World Bank recommendations. If your program is going to succeed, like set up a modern securities market to reduce the cost of international banking and be able to tap into the savings of the local population, you really have got to have a local team with senior officials and hopefully a minister behind it. Even then, you won't necessarily succeed. I mean, there are lots of problems along the way. What you can often find, unless the finance minister of the country concerned is closely involved with it and you have easy access to him to check things along the way, you can end up in a sort of limbo land between IMF recommendations, seeing this individual item, say, setting up a government securities market, as something which will help with fulfilling the program and producing growth, in one case by reducing the cost of borrowing. If you don't have that, then you end up arguing with the finance minister, and that's not a good position to be in. I mean, you can win little things sometimes, and the more you're trusted, and it depends on the character. I mean, the best example of this is not from a region, where we eventually developed a good relationship with the finance minister. This was in Jordan. He was actually a Palestinian Christian, but broad-minded. You can't. What you don't want to have is another set of local officials, and I had this in Romania, who are working against you, and usually working against you to frustrate the reforms. which in our case, it's frustrating. You have enthusiastic, usually young officials, and we found a senior official in the Ministry of Finance blocking the reforms directly and indirectly for, well, his own particular reasons. I won't say anything about that at this part of the proceedings, but you can, if you're interested, ask afterwards when we're freer to speak. So it works better if there is a local team dedicated to reform, and the advisor will get on best if he minimises the part he or she plays, and if there's credit going, let the local officials take it, because it's crucial that an advisor in this often quite detailed situation can be trusted. Lots of examples of that. I mentioned Romania. Hungary is not in our region, but because I worked a lot there, we had an enthusiastic reformer in the finance minister at the time who had been at the central bank. And the climate, it was a receptive climate. It was good earth. Next point is you have to involve the market in your reforms, in my experience. You can't produce a sort of top-down program. My best example of this was in Bulgaria in the early days. I went back later. What tended to happen is you fly in for 10 days, or just like the IMF missions I was criticising, but there was often, and then give people tasks to do, homework I called it, not to their face, and then go and review it. So once I found in Bulgaria, I hadn't actually asked them to draw up regulations for the government securities market, but they'd gone ahead and done it, which was great news. And I came back and I said, it's wonderful. I said, I have one or two comments here, and that means a lot of comments. But what's the market's reaction to this? Oh, we haven't consulted the market. We wanted to show them to you first, and that was okay with me. But we can't tell them in advance what it's going to be, because, one bank will get an advantage over the other or something. Yeah, I said, but if no banks, and I said, to be honest, no bank will sign up to this. No bank will participate in the market, because there's a whole long list, good bureaucratic communist tradition, whole long list of what they should do by way of obligation, but where's the incentive? Okay, you might make money. And they said, no. Okay, I said, all right. I said, we'll make a presentation to the market. And of course I had to give it. And I said, we'll then have a meeting to discuss it. Not a single bank would enter it, because it was all downside and no upside. And it was just the mindset that, and it was authoritarian. It's more difficult to achieve reforms in these circumstances. And we got there in the end, but it took perhaps 2 years when there would be a lot of advantages to set up the market. Similarly, I know I'm quoting Hungary on the good side, and that wasn't always the case. But when I did a similar thing in Hungary, there was an old broker sitting where Richard is there, who had been a runner, that's a boy messenger, on the last Budapest Stock Exchange before the Russians shut it down. And I knew him sort of from outside. And it was the absolute ideal first question. He said, how do I make money out of this? And it's an easier climate. I mean, there are other dangers. Right. Now you can't really read that. I didn't put, Well, we've had a technical problem, Adam, but I'll go over it just at the end briefly. My heading for this is Les Mains Sales. In more detailed, it's in the early days, the market may need support and even manipulation.
Sorry, it's moving along.
Yeah, that's Julie has been labouring. It's probably much more interesting than what I'm saying, so not irrelevant. A few examples of this. I don't want to become too detailed, but in the early days of the market.
Sorry, if you could fix it.
Yeah.
Yeah, Julie and I tried, but we couldn't.
It'll stay almost.
Okay.
I feel good. Yeah. I've just got about 5 minutes more. We're not.
I took half an hour. Take half an hour. Yeah, we're late starting. So.
What?
Sorry, yeah.
Yeah,
We're fine. We're fine.
Okay, fine. Yeah. Sort of things you don't over-regulate, but what you must do in the early days is stamp on scandals or banks being undercapitalized, because particularly if you're selling government securities, the one thing you must avoid is a loss of confidence. The government has got to be trusted, and in many countries, including some of those we're talking about, the back history has not encouraged people to trust the government. In Poland, for example, in a period of high inflation, I thought that we did a survey, a populist survey, and the one thing people wanted was some government instrument in which they invested, and after 6 months would deliver a safe, guaranteed return, not one corrupted by inflation. And I proposed an inflation-linked short-term bond, because that's what the majority of the people wanted. Now, the IMF, you would not be surprised to hear, disapproved and said no inflation-linked instruments. And of course, they'd had a lot of experience of bonds which had become inflationary, because there was an inflation guarantee of one kind or another. I thought that the government were serious in bringing down inflation, which was very high. It was 40% per annum. IMF was against me. I was a bit obstinate. We argued, and I had some chums in Washington, and so exception was made. I was nervous about it, but the gamble worked, and inflation came down, so it was actually cheap finance for the government, and the people went out and bought the fridge they'd been saving up for 2 years and never quite made it. Not big stuff, but improved also the credibility of the government. Problems? In over half the countries I've worked, the Ministry of Finance and the central bank have been barely on speaking terms. And that's a huge problem. A number of reasons for that. Often in post-communist countries, the structure of the central bank had not changed, and a lot, for various reasons, some of which are cultural, the clever people went into the central bank. And they thought they were cleverer than the Ministry of Finance, and that causes real problems, particularly as you get to higher levels. I did 4 jobs in Hungary, working for 4 governments. It's a balancing act, if you like. And basically, when I was at the Ministry of Finance, I advised against having a separate authority. FSA had just been set up to do banking supervision. I argued then, as I would argue now, and we see the wheel has turned back again, that while the academics were very insistent that your monetary policy would be contaminated, or could be contaminated, if you were also responsible for banking supervision, I argue, and I think history is on my side, plus practice in many European countries, which never went in for the separate. I'm sorry Chris Alsop isn't here. This is a subject on which he and I disagree. With me, if you like, taking the part of those who say what works, because humanity will obviously, you need the commercial banks. And also there is always the danger, if you set up a separate institution, there's close cooperation. In the case of the Bank of England, when supervision was taken away from the bank by Gordon Brown, and then of course the staff just transferred, and that's all right. But eventually separate organisations have separate cultures and failed. So in Hungary we had to start again basically, and I actually set up what I called a market watch unit, staffed with hand-picked ex-central bank people because they knew what they were doing, and inserted that as a way of making sure that the actual banking supervisors took a central bank and Ministry of Financial issues into account. I mean, given that the decision had been made, which Hungary incidentally has reversed. It's all back in the central bank now. You can't win them all, but this was a compromise to ensure that the three bodies, which have different interests, work together. Now, one or two things just to mention briefly. One is that in this matter of giving and what I've concentrated on, taking of advice, receiving it, it can be useful to encourage local cooperation and rivalry and set up a sort of, well, there was one set up in Vienna, Joint Vienna Institute. A lot of it was about training, but some of the rest of it was encouraging consistent good practice and even a bit of cooperation. So countries can sometimes rival themselves to set this up, partly because they all want to be boss. One of it's an anecdote, but it's illustrative and it's important, and I shall not repeat. When I was at this Centre for Central Banking Studies, sort of after hours, as it were, I enjoyed it. We developed a sort of business game. I made a big mistake. I had national teams thinking they could converse in their own language, or it would be easier, rather because not everyone had sufficiently fluent English. What happened was a sort of continuing row throughout the various stages of the game, and the Slovaks accused the Hungarians, who wanted to win and were the real winners because they applied themselves to it, whereas certain other country teams discussed it in the pub, and the Slovaks were accused of cheating. The answer was the Slovak team did cheat, but I let it run just to see how it would resolve itself. I never did that again because it was no good. It was even worse when we had a Russian team. Lastly, it's not often talked about, but the advisor, particularly if you're a long-term advisor, has a number of difficulties. And I've certainly experienced all of these. Some of it may seem obvious, some less so. What I've written here is you have to be technically expert. I mean, like the professor and the undergraduates. Because if you're a charlatan, you are soon exposed. And anyway, that would not be right. But the other reason is, if you are not technically expert, you have no credibility. So you can forget it. You also have to be seen to be on the side of the country you are advising. And I've made mistakes in this area as well. But equally, you've got to go with the technical team and defend yourself, whether it's in the parliament or front of the finance minister, and you've got to be on the side of the local team. What you want to avoid, and it can too easily happen, is your report, with a lot of help and effort from the local team, including very bright young people, is just put on one side. It's another report to be looked at, maybe. What you've got to do is to try and make sure that you check where you are with the political authorities along the way, and you keep them informed of progress so that you and they don't end up on collision courses. So it's, I'm sure David will recognise, it's a bit of a diplomatic job as well. I always used to try and stand behind press and public relations, but you couldn't always do that, and it became a credibility problem. If you're not publicly on our side, and this, I'm sure Stewart will maybe have something to say about this, it can go wrong, and I've seen it go wrong, and sometimes spectacularly wrong. And lastly, I throw this in because, again, I've seen this go wrong. Sometimes you have to behave, how shall I say, appropriately in a foreign country. And that's where a lot of technical advisors, some quite well qualified, have, to be old-fashioned, let themselves down and the country down, and diminished the quality of the advice by personal behaviour. That's not often said, but I say it because it really matters. So,
Robert, thank you. Adam?